invest in 3 buckets of money. There's 3 different types. And these buckets, okay, represent where we save and invest our money. This one is called Tax Me Now. This one's called Tax Me Later. And this is called Tax Me Never. Okay? Tax Me Now. These are accounts like stocks, bonds, mutual funds. Okay? Tax Me Later. 401k, IRA, pensions certainly fall under this category. Okay? Qualified plans, meaning the money goes in before we pay tax on it. When we withdraw, that's when we have to start paying tax. And then you have never. Okay, that would be Roth IRAs, cash value life insurance, CDLI. And then there's another one called tax-free municipal bonds. Okay, so all of this is a great way to position our assets and grow wealth. But if you pay tax along the way, your account value won't nearly grow as much as if you never pay tax. So this is what I wanted to talk about when it comes to saving and investing on a tax-free basis. And we're going to focus on this one here, the Tax Me Never. Okay? So now that you have that, let's talk a minute about how do we do that. Okay? So here we are as a country with $30 trillion in debt, national debt, right? How do we position ourselves? Now, we've always said, and you've always heard, that you should be diversified, right? Put your money in various types of investments, anywhere from the safe, the moderate, and aggressive arenas, okay? Whether you're talking to a financial guy, a CPA, insurance guy, banker, it doesn't matter. The point being is that everyone talks about being financially diversified. And you probably would agree that's a good idea, okay? So if we were to draw this line right here, assets that we accumulate above this line are sometimes referred to as paper assets because their value isn't fixed until they're sold. Assets below the line represents what we call real wealth, meaning their value doesn't go down. They usually pay some sort of interest or dividend, and they're fairly safe, okay? So how do we best position ourselves so that we can take advantage of real wealth down the road? Assets above the line are sometimes referred to as paper assets, right? Because if you're invested in the stock market goes like this. This means nothing until you actually sell those investments and realize those gains, okay? So the Wall Street rule of thumb suggests you should have a percentage of your assets equal to your age below the line. So for instance, if you are 20 years old, you would have 20% of your assets below the line and 80% aggressive. Conversely, if you're 80 years old, you'd have 80% of your assets below the line and only 20% at risk. Make sense? Okay, so let's see how we position things here. If you're diversified like that, that's great. You also have something called the tax fence. And if we were to draw a line through here, we have pre-tax investments, and then on this side here we have after-tax. What do I mean by a pre-tax investment? Okay, pre-tax investment means the money goes in before it's been taxed. For instance, you have a 401k, you have an IRA, you have a pension plan. These are programs where the money goes in before it's taxed. Everything else, by definition, goes on this side of the tax fence, okay, where you save and invest your money after you've paid tax, okay? Back in the early 80s, when these plans were popularized, take a guess at how high the tax rate was back then. I'll give you a little hint. It was 70%. 70% was the highest tax rate back in the 80s when these plans started out. It's shocking, isn't it? So here we are today. We have 7 different tax brackets, the highest of which is 37%. The lowest is 10, okay? So what we're trying to do here is position ourselves in such a way that we have more spendable income in retirement, right? You work hard for your money. The last thing you want to do is pay more in taxes. So the problem here today is, if back in the 80s and 90s when these plans were popular, if someone said, hey, Dave, I wanted to, I make $100,000, okay? When I retire, I don't need $100,000. I can live on $80,000, inflation adjusted. And that's great, because the idea was when I retire, I'm going to move down, what? A couple tax brackets. So I don't need $100,000 to live on. I can live on $80,000, okay? And that plan worked beautifully for those that have retired in the 80s and 90s, okay? But here we are today, like I said, with these 7 different tax brackets, the highest of which is 37%. Most people fall in the 22 to 25% tax bracket. Now, we know one thing. January 1, 2026, the tax cuts of 2018 will expire, and we will go back to the previous tax plan, okay? So how do we position ourselves? First off, many people today are deferring taxes at 22 to 25%. Only if tax rates go higher in the future, this would be a major, major mistake. Why? Because when we start taking money out of this side, we're going to be in these types of plans, we could potentially be in a double tax rate. We can be 30, 40, 50% tax rate. And so deferring tax today to get a tax deduction today is silly. Why would you do that? It's like going to the store and saying, hey, you know what? I'm not going to buy that refrigerator today for $2,000 because it's on sale for $500 off. I'm going to wait till next week till it's full price. That's crazy. Don't do that. Now, what I'm not suggesting is that you go and you stop contributing to your 401k and IRA, especially if you have a company match. The first rule of accumulation, take the free money, right? So what are you supposed to do? Here's what you do. Invest all the way and contribute all the way up to the company match. Let's see how we can position this. So remember we said you're going to live on $80,000. Okay, if we have 2 bags of money, and if this is a bag of money here, and we have a bag of money over here, the idea is to say, okay, what if I take $40,000 out of that bag of money? Okay, that'll put you in one of the lowest tax rates at the time, okay? Great. Today it'll land a couple in about a 15% tax bracket. Actually, more so like 12. That'll put you in like a 12% tax bracket, okay? But you said, Dave, I can't live on just 40 grand. I need another 40,000. So we take the other 40,000 out of this bag, okay? Now, if we set things up properly and follow the rules, how much of this is taxable? 0. So if you're paying 12% here and 0% here, that gives you a net of 6% total taxable income in retirement, which is exactly how this plan will work, or is working for those that are retired, because they deferred at a much higher tax bracket in the 30 to 40, 50% bracket, and they're paying tax in a much lower bracket. So what are some examples of after tax? How can we position ourselves? Well, one of them is what's called the Roth IRA. The Roth IRA allows you to contribute money into it on an after-tax basis, so you can grow that account to however large you want it to. $1 million, whenever you take the money out, you pay 0 tax, okay? Another strategy we use, cash value life insurance. These are golden nuggets of the tax code. If your CPA isn't telling you about this, then maybe it's time to go find another CPA. Roth IRA, cash value life insurance, where you stuff money inside of a life contract, let it grow tax deferred, just like these accounts, and when you take it out, it comes out tax-free. We tend to use this plan for those that have a need for life insurance and want to save on an after-tax basis. And that last thing is that tax-free municipal bonds, okay, where the income you earn off of that is tax-free for the most part. That works really well for those that are in retirement or near retirement that are looking for after-tax for income, okay? So that's a great strategy. So my whole point about doing this is that because what we want to do is we want to change these paper assets into real wealth and get you into the lowest tax bracket as possible, okay? So here's what I'm going to ask that you do. Call, click on my electronic calendar. You'll see the link here on this video. Click on that. Call me. Let's have a discussion. How can we position yourself so you can pay the least amount of tax but still grow your assets? Because that's really what's going to happen here. When tax rates go higher, you can be making a major financial mistake right now by putting all of your nest egg into the 401k and IRA and paying the tax today. Call me. Let's have a discussion. I appreciate you taking time to look at this. Like this video. Follow me on Twitter, Instagram. Follow me on Facebook and LinkedIn. Thanks.